Welcome back to the Deep Dive. So today we're going to jump right in. We've got an interesting article from the Motley Fool, published really recently, April 9th, 2025, with a headline that I think will grab everyone's attention. The stock market has crashed. My top 5 dirt cheap tech stocks to buy now.
Wow, that is quite a statement, isn't it? And yeah, it comes at a time, as you said, when the market's been, experiencing quite a bit of turbulence. So as the headline says, the article focuses on the tech-heavy Nasdaq composite and highlights the fact that it's dropped more than 20%, which, well, it's pretty substantial.
It is, yeah. And it's not just stating the fact. The article actually tries to, dig into the why behind it. The author points to investor concerns about corporate earnings, and just the bigger economic picture, right? Particularly with President Trump's recently announced import tariffs. So what we want to do today is really try to understand this market reaction, like unpack it a little bit. Why have these tariffs, caused such a stir, especially within the tech world? And then we'll shift our focus to the 5 specific tech stocks that the author highlights as, well, potential buying opportunities, those so-called dirt cheap stocks, as the headline says. We'll be looking at, why the author believes that these stocks are now, particularly attractive to investors. So hopefully by the end of our discussion, you'll have a clearer picture, a better understanding of, what's happening. And we'll have some really concrete examples of, the companies that are being talked about. So
sounds like a good plan. Let's do it.
So let's, jump right into it, shall we?
Yeah, let's dive in.
All right. So, the article kind of sets the scene, right, by immediately focusing on President Trump's announcement of these new import tariffs, which are going to impact, goods coming into the United States from, well, a whole range of countries, right?
Yeah. And I think, what's really important to consider is that this announcement immediately impacted the tech sector.
And that makes sense, right? If you think about how interconnected the global supply chain is, especially for tech, these companies, they rely on components, finished products that are, manufactured all over the world.
Right.
So these new tariffs, what they do is they basically act as like an additional cost.
Right.
Right. They make it more expensive to bring, all those goods into the U.S. because of those import duties.
And so almost overnight, the cost of doing business, has the potential to increase for these tech companies. And I think that's really where we see the investor reaction coming in. So as the article mentions, investors started, becoming concerned about future tech earnings. And so we saw an immediate response of, sort of moving away from tech stocks. And as a result, there were some pretty significant drops in the valuation of, well, even some of the, most prominent, well-established players in the industry.
Right, right. And it wasn't just, the smaller, more speculative companies that felt this impact.
No, absolutely not.
I think this, this kind of highlights, how investors tend to react to uncertainty, right? When there's this perceived risk to the economic outlook, particularly when it's, related to government policy. Like in this case, well, investors, they often, prefer to sort of reduce their exposure, right, to potentially volatile sectors. And tech stocks, well, despite their, long-term growth prospects, they can be seen as, kind of more sensitive, more susceptible to these, macro shifts, right, compared to maybe some other more stable sectors.
That's a good point.
So the prospect of, increased costs because of these tariffs, it creates, uncertainty around profit margins.
Yeah.
And that often leads to, a sell-off, people wanting to, get rid of their stocks.
Yeah. And, the article does acknowledge that these tariffs, they present a genuine risk.
Right.
But it also offers a bit of historical context, which I think is quite valuable here. So it points out that, historically, strong companies, they've navigated all sorts of economic challenges, right? They've adapted their strategies, and they've ultimately recovered. And, the author even suggests that it's rather unlikely that, governments and the tech giants themselves, would simply allow a worst case scenario to play out, unchecked.
Yeah, that's a really crucial perspective, I think, especially for anyone who's, thinking about long-term investing, right?
Yeah.
It's true that, short-term market swings can be dramatic, but companies that have solid fundamentals, right, that have a strong position in their market and that are able to innovate. I mean, they often find ways to, overcome these temporary setbacks. The author's suggestion that we might see, maybe some kind of like coordinated response, right, from both the government and the tech industry, well, that seems, plausible given the really significant role that the tech sector plays in the global economy as a whole.
Yeah, that's a good point.
Okay, so with that understanding, right, of the market backdrop, the dip in the Nasdaq triggered by these tariff concerns, let's move to the core of the article. Right? Let's dive into those top 5 tech stocks that the author believes are now dirt cheap, as they put it.
All right, sounds good.
So first up, we have Nvidia. The ticker symbol's NVDA, and the article highlights that Nvidia has this massive market capitalization of like $2.8 trillion, right? And it experienced a pretty significant single-day drop, over 18%, on April 9th, which brought its price down to around $114 a share.
Right.
And what's interesting is that Nvidia is now trading at approximately 21 times its forward earnings estimates,
Which is a significant decrease from the roughly 50 times that it was trading at just a few weeks prior.
Yeah, wow.
And for our listeners who may not be familiar with the term, forward earnings estimates are basically analysts' predictions, right, of a company's future earnings per share.
Right. So it helps you get a sense of the current valuation, right, of the stock.
Exactly.
Okay, so what's particularly interesting about NVIDIA is its position as this dominant force in the world of AI chips, right?
Yeah, absolutely.
And the article emphasizes their impressive revenue growth recently, describing it as double and even triple-digit percentage increases each quarter, all fueled by the surging demand for artificial intelligence, for AI technology.
Yeah, definitely. And the author even mentions, CEO Jensen Huang's estimate that there are about $1 trillion worth of older computers worldwide that need upgrading to be able to handle AI. So it really highlights the enormous future market opportunity here.
Yeah, it really does, and it kind of gives you a sense that we are still in the very early stages of this whole AI revolution.
Oh, without a doubt. And NVIDIA isn't just sitting back and watching this happen. The article points to the recent launch of their Blackwell chip architecture, and apparently the demand for it is far exceeding what they can actually supply at the moment.
Yeah.
Which really underscores their technological advantage. Plus their commitment to releasing these new chip updates every year. Well, that signals their dedication to maintaining that leadership position.
Exactly. And if we kind of step back and look at the bigger picture here, the long-term trend of AI adoption right across so many different industries, it just seems incredibly strong. So while these tariffs, they might create some short-term cost pressures, the underlying demand for NVIDIA's specialized hardware, right, for all these AI applications like training, inference, that's likely to continue and even grow significantly in the years ahead.
I agree, and that lower forward earnings multiple that we were talking about, as the article points out, that could actually represent a more attractive entry point for investors who are thinking long term.
Definitely. Okay, so moving on to the second stock on the list, we have Meta Platforms, the ticker symbol's Meta. And the article notes that it's trading around 20 times its forward earnings, which is down from 29 times back in February. And it also experienced a significant drop on April 9th, about 14.45%, bringing the price down to roughly $584 a share. Now, Meta is obviously a well-established leader in social media, right? I mean, we've all heard of Facebook, Instagram, WhatsApp, Messenger, but the author here is highlighting their ambitions, their growing ambitions in the AI arena.
Yeah, that's really interesting. I mean, it seems like Meta wants to be more than just, a social media company. They seem to be really serious about becoming a major player in AI, beyond just powering their own platforms. And the article even mentions, Meta AI, which is already, integrated across their apps, and they say it has the potential to become like the most widely used AI assistant globally. So it seems like their long-term vision is, really about incorporating these AI assistants to kind of, help users with all sorts of things.
Yeah, that's a pretty ambitious goal, right? To be like the go-to AI assistant for everyone.
Yeah, absolutely.
So what's driving this big push into AI? Like what's a rationale behind it? according to the article.
Well, it seems like, their main goal is to increase user engagement.
Okay.
Right. So the idea is that these AI assistants, they'll encourage users to spend, more time within Meta's ecosystem, within their apps, basically.
Right.
And that, in turn, should positively impact their advertising revenue.
Okay, so it's all about, keeping people on their platforms for longer so they see more ads.
Yeah, that's the basic idea. And the scale of their investment is, quite impressive. They're planning to spend something like $65 billion in AI this year. And they're also building this, massive new data center. So, author seems to view this, current stock dip as an opportunity, right, to invest in not only their, established dominance in social media, but also their potential to become, a really major force in AI.
Wow, that's a huge investment, $65 billion. Are there any, key milestones or like metrics that investors should be watching, to kind of gauge the success of this strategy?
Yeah, that's a good question. I think investors should probably keep an eye on, the user adoption rates of Meta AI, how those, AI features are actually impacting user time spent on their platforms, and ultimately, how these AI integrations are, translating into increased advertising revenue growth.
Yeah.
And, I think another thing to watch is the progress on the development and efficiency of their new data center infrastructure, because that'll be, a pretty key indicator of their commitment, and their capacity to actually execute on their AI strategy.
Makes sense. All right, so let's move on to the third company on the list, which is Broadcom. The ticker symbol is AVGO. And the article emphasizes their position as, a networking powerhouse. They produce a wide range of products that are particularly critical for data centers. Their shares are now trading around 23 times forward earnings, which again is down from over 35 times earlier this year. And they saw a pretty significant drop on April 9th, about 18.31%, bringing the price down to roughly $184 a share. So what's driving Broadcom's recent success?
Well, the article points to their soaring revenue from cloud service providers as they scale up their AI infrastructure.
Okay.
So basically, as these cloud providers are building out their AI capabilities, Broadcom is really benefiting from that trend.
Gotcha.
And what's interesting here is that, Broadcom is playing a really pivotal role in enabling this whole AI revolution, from an infrastructure perspective. So, we've been talking about companies like Nvidia that are known for the chips that actually train and run the AI models.
Right. Yeah.
But Broadcom, they provide those essential, networking solutions and what they call XPUs, or accelerated processing units. So these are specialized processors that are increasingly being used in data centers to handle, the massive computational demands of AI workloads. And so, Broadcom's solutions basically help to, manage the flow of data within those vast AI data centers.
Okay, so they're kind of like the plumbing, if you will, of the AI infrastructure.
Yeah, that's a good way to put it.
All right, so the article also mentions a pretty remarkable statistic.
Yeah.
A 77% jump in their AI revenue in the most recent quarter.
Yeah, that's huge.
Right. It exceeded $4 billion.
Wow.
And the expectation is that this strong growth will continue. They even have some projections in the article about these three major cloud service providers, and they anticipate that each of them will have like 1 million XPU clusters by 2027, and Broadcom is actively working with other cloud providers to develop these custom AI accelerators. So it really does seem like they're deeply integrated into the infrastructure build out that's really necessary to support the whole expansion of AI.
Yeah, and I think this, highlights an important aspect of the AI ecosystem, which is, the diversification within it. So, while much of the focus is often on the AI models themselves, the underlying infrastructure, that powers these models, it's equally vital. And so Broadcom's, strong position in networking and their, increasing involvement in these custom AI accelerators for, these big cloud providers, Well, it suggests a robust and potentially less directly impacted growth trajectory, even amidst, these global trade uncertainties.
Okay, got
So,
it.
that significant reduction in their forward earnings multiple, that could be seen as, another attractive opportunity to invest in a, key enabler of the AI revolution.
Definitely, definitely. Okay, so the fourth company on the list, we have Oracle. The ticker symbol is ORCL. And the article notes that it's trading at around 21 times forward earnings, which is down from over 30 times just recently. It also experienced a drop on the 9th, about 12.17%, putting the price around $139. So Oracle's recent growth, according to the article, is being driven by their expertise in database management and their flexible cloud offering, and apparently their cloud integrates really smoothly with other major cloud platforms like Microsoft Azure and Amazon Web Services.
And what's really interesting about Oracle's recent performance, it's their success in the multi-cloud environment. So the article points out this pretty impressive 92% surge in their multi-cloud database revenue from, Microsoft, Amazon, Google Cloud, just in the recent quarter. So, this suggests that their strategy of providing, a flexible, interoperable cloud solution is really resonating with customers.
Okay.
And, the record customer demand they're seeing and their plans to, double their data center capacity, well, that just further underscores this strong growth trajectory.
So it's not just their, current revenue that looks promising.
Exactly.
The article also highlights, a substantial $130 billion in remaining performance obligations. So, to kind of put it simply, that's like a really large backlog, right, of signed contracts, which gives, good visibility into their future revenue. Is that right?
Precisely. Yeah. It represents, contracted revenue that hasn't yet been, recognized. So it provides, a strong indication of, future revenue stability and potential growth.
Okay.
And so, the author's argument is basically that Oracle's cloud strategy and particularly its, multi-cloud capabilities, well, that positions it, really well for continued growth.
Gotcha.
And so they're saying, this recent stock dip, it might be, a potential buying opportunity.
Makes sense. Okay, so finally, rounding out the top five, we have Alphabet, encompassing both, GOGL and GOG tickers. The article notes that they're trading at, around 16 times forward earnings, with, share prices around $159 and $161 respectively. And they also experienced, a drop on the 9th of, roughly 10%. The author kind of makes a point of saying that Alphabet is, currently the cheapest of the Magnificent Seven tech giants.
Oh, interesting.
Right. And its, core strengths are, of course, Google Search, which is, the world's most popular search engine. And, it's high-growth cloud service, Google Cloud. And, both of these, of course, generate billions in earnings. And like, Meta, Alphabet is making some, pretty significant investments in AI, leveraging its, Gemini large language model.
Yeah. And what stands out with Alphabet is, their just foundational strength in search and their, rapidly expanding cloud business. And together, those two really provide, this robust financial engine to fuel their AI ambitions. And the article highlights their, significant investment in AI with a planned, $75 billion in capital expenditures this year. So it really signals a strong commitment to long-term leadership in this space. And their strategy, involves integrating, their Gemini AI model to enhance, Google Search. And they're also offering, Gemini-powered tools through Google Cloud.
Right. So the argument here is that, you're getting a dominant search engine, you're getting a significant player in the cloud computing space, and you're getting a company that's, making these massive bets on the future of AI, all, at what the author considers to be a relatively attractive valuation compared to its peers in the Magnificent Seven.
Yeah, I mean, this raises an interesting point, about how investors assess value. And while the term cheapest, it can be subjective, Alphabet's combination of, a dominant market share in search, a strong and growing presence in the cloud, and these substantial investments in AI, coupled with a lower forward earnings multiple compared to some of its peers, well, that could indeed present a compelling long-term investment case for those who are, optimistic about their ability to successfully execute their AI strategy, despite any potential macroeconomic headwinds.
So to recap our deep dive, into this Motley Fool article, what we've seen is that the recent downturn in the stock market, particularly affecting the tech sector, due to concerns surrounding President Trump's new import tariffs. Well, this has led the author to identify what they believe are some really significant buying opportunities in fundamentally strong technology companies, and we've gone through these companies. Nvidia, the leader in AI chips, Meta Platforms with its established social media platform and its growing AI ambitions, Broadcom, a crucial infrastructure provider for AI technologies, Oracle with its successful multi-cloud strategy, and Alphabet, the search and cloud giant that's making these substantial investments in AI.
Right.
And each of these companies, according to the article, possesses its own distinct strengths and significant potential in these key areas such as artificial intelligence and cloud computing.
Absolutely, and it's really important for our listeners to remember that this analysis is coming from the Motley Fool, a financial services company that offers its own investment perspectives and recommendations.
Yeah, it's always important to keep that in mind, and that brings us to our final thought for you today. Considering the long-term, transformative potential of these tech giants, and considering the, constantly evolving, landscape of global trade, what specific aspects of these companies' strategies, whether it's Nvidia's, chip innovation or Meta's AI integration or Broadcom's, infrastructure role, Oracle's cloud flexibility, or Alphabet's, AI investments, or even, what aspects of the broader economic and political situation do you find, most compelling or concerning for their future growth? And how might these factors influence your own thinking and your potential decisions moving forward? It's certainly a moment to take this information, maybe conduct some additional research on your own, and really consider what it all means for you in the long run.
Yeah, I think that's a great point.
Well, that's all the time we have for today.
Thanks for having me.
Thanks for joining us.
See you next time.